LOS W. Identify and explain international measurement issues for multinational organizations. Multinational organizations face performance measurement challenges due to transfer pricing, which affects reported revenues and profits across subsidiaries. Transfer prices influence tax liabilities, managerial incentives, and divisional performance evaluation. Improperly set transfer prices may distort true economic performance and create internal conflicts between units operating in different tax jurisdictions. Currency fluctuations introduce exchange rate risk when consolidating foreign subsidiary results into the parent company's reporting currency. Changes in exchange rates may distort revenue, expense, asset, and liability values, complicating trend analysis and performance comparisons. Differences in product standards, regulatory requirements, and income tax regimes across countries affect cost structures and profitability. Managers must adjust performance evaluation frameworks to account for these structural differences to ensure fair and accurate assessments. LOS X. Discuss problems in measuring performance, including short-term focus and sub-optimization. A major problem in performance measurement is excessive emphasis on short-term financial results, which may discourage long-term investments in innovation, research and development, employee training, or brand building. Short-term metrics can incentivize cost-cutting behaviors that undermine sustainable competitive advantage. Sub-optimization of goals occurs when individual departments or divisions optimize their own performance metrics at the expense of overall organizational objectives. For example, a production department may minimize costs by producing excess inventory, negatively affecting company-wide profitability. Poorly designed measurement systems may also ignore non-financial drivers of performance, such as customer satisfaction or process efficiency. Balanced metrics aligned with strategy help reduce distortions and support long-term value creation. LOS Y. Recommend guidelines for effective evaluation systems. Effective evaluation systems should focus on a minimum set of key performance indicators directly linked to critical success factors. Overloading managers with excessive data reduces clarity and distracts from the most important strategic priorities. Monitoring should concentrate on high-impact activities and measurable outcomes. Performance measures must be timely and balanced, incorporating both short-term and long-term indicators. Leading and lagging metrics should be combined to provide a comprehensive view of strategic progress and future sustainability. Evaluation systems should emphasize management by exception, accountability, and appropriate rewards. Clear responsibility assignments and incentive alignment encourage desired behaviors. Consistent feedback and transparent reporting strengthen strategic control and organizational discipline. LOS Z. Define and describe the importance of a post-completion audit for strategic initiatives. A post-completion audit is a formal evaluation conducted after a strategic initiative or capital project has been implemented to compare actual results with original projections. It assesses financial performance, operational outcomes, strategic alignment, and risk assumptions. The purpose is not to assign blame but to determine whether expected benefits, such as revenue growth, cost savings, or market expansion, were realized. Post-completion audits strengthen accountability by reviewing forecasting accuracy, capital allocation decisions, and execution effectiveness. They highlight gaps between projected and actual cash flows, timelines, and return metrics, enabling management to identify systematic planning errors. Most importantly, post-completion audits promote organizational learning. Lessons derived from past initiatives improve future investment analysis, risk assessment, budgeting accuracy, and overall strategic decision-making quality. LOS AA recommend performance measures and periodic reporting methodology. Recommending performance measures requires aligning metrics directly with operational goals and strategic objectives. Financial measures such as revenue growth, margin improvement, and return on investment should be complemented by non-financial indicators like customer satisfaction, process efficiency, quality metrics, or employee engagement, depending on the organization's priorities. The reporting methodology should include a structured schedule, monthly or quarterly reviews, with clearly defined targets, variance analysis, and explanation of deviations. Dashboards, balanced scorecards, or KPI summaries can improve clarity and accessibility of information. Effective reporting emphasizes timely data, management by exception, and clear accountability. The goal is to provide decision-makers with concise, actionable insights that support continuous performance improvement and strategic alignment. LOS BB. Prepare a summary analysis and memo reporting results given a scenario. Preparing a summary analysis requires synthesizing financial and operational data into clear conclusions regarding performance relative to strategic objectives. The analysis should highlight key variances, underlying drivers of results, and trends affecting profitability, liquidity, efficiency, or market position. An effective memo format includes an executive summary, performance evaluation, identification of strengths and weaknesses, risk considerations, and recommended corrective actions. The tone should be objective, concise, and data-driven. Recommendations should align with strategic priorities and consider both short-term operational improvements and long-term competitive positioning. Clear communication of findings supports informed decision-making and reinforces accountability throughout the organization.